Exxon Mobil Corp, ticker symbol XOM, is currently trading at $108.26 a share. Over the last year, it is only up about 6%, and this is due to a recent 10% drop. Is this the right time to buy? That's the question we're going to be answering today. Now, this stock is also popular for other reasons, as it does pay a very nice 3.67% dividend yield. We're going to be looking at the stock's financials, then seeing if it is a buy or sell using the discounted free cash flow model, comparable company model, dividend discount model, and the Ben Graham formula for intrinsic value. Just going through the stock quickly, over the last 5 years, it is up 54%. At the bottom of the pandemic, the 2020-2021 COVID years, the stock even was about $36 a share, and since then is about 200%. The stock was a must buy in 2020, 2021, and half of 22, but it has been trading relatively flat since then. So let's have a look at my automated stock valuation spreadsheet. Oops, wrong page. Here we are. And if we put in the ticker Exxon or XOM, it'll load all the latest company financial data, and then we can have a little compare. So $108 a share, $500 million in market cap, PE of 13.64, which means it is much lower than the market average, which is about 31. $8.03 earnings per share, and a beta of 0.89, meaning it's less volatile than the market. Analysts interestingly do say it is a buy with a target price of $130 a share. More on the dividend, 3.65%, which means they pay $3.94 per share. Dividend is safe. They pay around $17.3 billion each year, and in terms of free cash flow payout ratio and net income payout ratio, 68 and 51% respectively. If you want to get paid this dividend, buy before the 14th of February 2025, and you'll get paid the quarterly dividend. So, having a look at revenue numbers. Currently $350 billion, down from its prior highs or most recent highs of 2022, but since the pandemic it is trending in the right direction, not back up to the previous numbers back in 2010 to 2014. Now, with this profit, are they able to generate, with this revenue, are they able to generate more profit? The answer is somewhat, 33.7 billion in the trailing 12 months. Free cash flow, is that up 25.23. You can see it is actually one of the worst years in recent times since the pandemic year. Pre-pandemic, 2015 to 2019, it is beating that, yes, but they had some big jump up years and is now on a bit of a decline. If we look at the operating cash flow versus capex, you can see operating cash flow is slightly increasing, which is good from the last year. It's that capex has increased, which has then brought the free cash flow down. Shares outstanding, what they're doing? Well, they're actually recently been doing a buyback program rewarding shareholders through buying back the shares. That is good. There was a slight increase between 2016 and 2021, but over the last 2 years, an aggressive buyback program back to what they kind of had in 2011 and onwards. So, having a look at the discounted free cash flow model, this is a way of valuing stocks, looking at their future free cash flows and discounting them to today's value. And currently it's giving us a price of $30 a share, which does seem quite low. Let's have a look at these numbers. So first we'll look at revenue estimates. We're estimating 380 and 420. So we will see if analysts agree with these. Sorry, I've got a bit of a cough. A bit all over the place actually. On the average, they're actually expecting declining revenues, 354 and 345 billion, but on the bull case, 375, 400. We'll actually do both of these and see what we get, but initially we'll do declining revenues. We'll do 3% is a bit much. We'll do -1. -1. Okay, that's pretty close. Net income margins, yeah, this is way lower than it should be. We'll take an average of these last 5 years, 10%, 10.4. And yeah, free cash flow ratio, what we'll do is we'll initially take the 75. And that puts us at about just under fairly valued, $111 a share. If we were to take an average of these numbers, which I think is a bit fair at 87%, that would put us at $129, $130 a share. And if we go to the share price, that is pretty much the all-time highs. Well, the all-time highs. There will be all-time highs, what am I saying? Yeah, it is all-time highs. Look at the max chart. So that is a pretty good estimate. Then also, if we were to be on the more bullish case, which was 375 and 400 billion, which would be about that, $174 a share. So I think discounted free cash flow really does like this stock. If you're interested in this sheet, please check out my Patreon. $1.50 to help me out, but if you want the sheet specifically, it's the $4 a month tier, and there is a larger tier if you're interested in that too. So, having a look at, we'll have a quick glance at the dividend discount model, see what it gives us. So currently, weighted average cost of capital discount rate, we've got about 8.8%. Expected growth, we would need to be at about 5% to be fairly valued, 5.5%, somewhere in that region. So currently they are decreasing like that, but if you look at 2020, that was kind of how they were growing the dividend until they paused the growth, and they are increasing. So that is good. Currently at 4.4%, it would be at $90, but if they get it to that 5 and upwards, then it would be a definite buy. Ben Graham formula for intrinsic value. This is a way of valuing stocks created by the godfather of value investing himself, Ben Graham. It looks at earnings per share, P of a growth company, AAA bond yield, corporate bond yield, and I don't think this will like this. Let's have a look at what analysts are expecting. So you get 3% growth, and this puts it at $79 a share, so not a million miles away. If they were able to grow it even 8, 9, 10%, then yes, but unfortunately 3 is not a buy. But my favorite model is the comparable company model. This is a way of looking at companies and looking at certain metrics and businesses of similar size in the same industry. We're going to be looking at some general numbers here: the revenues, the growth rates, the EBITDA, the net income, profit margins, price to sales, price to book, Peter Lynch's price to earnings growth. But the specific metrics that go into the model are EV to revenue, EV to EBITDA, PE. We also look at forward PE as well. So companies that I do think are very similar, we'll do CVX, which is Chevron. We'll do BP, which is just BP Inc., but British Petroleum, or used to be known as British Petroleum, and Shell, Royal Dutch Shell, or now Shell PLC. So in terms of enterprise value, Exxon is the largest, highest revenue, second highest revenue growth rate, highest EBITDA, most profitable as well. Price to sales, market average is around about 3, and they are all lower than 3. Price to book average is 5, they're all lower than that. PEG, it is the second highest, quite interestingly. EV to revenue, it's second highest. EV to EBITDA, second highest. PE, one of the lowest PEs, and forward PEs, actually one of the highest. So the current PE is one of the lowest, but the forward PEs is one of the highest. Puts it about $100 a share. This is because the EV to revenue gives you 80, EV to EBITDA gives you 80, and the PE gives you about 136, so that average is about 100. If we were to compare against Chevron directly, it would actually be a buy. But yeah, quite interesting. Looks like the pullback is, in terms of these other companies, quite similar. Right guys, thanks for watching. Please give a like on the video if you enjoy it. Subscribe if you're not already. Check out my Patreon, which is there, and I'll catch you guys next time.